afternoon and Happy New Year. We wish you all the best for 2023. I'm Pamela Hastings, Relationship Manager at Barometer Capital, and we welcome you to the third year of our Barometer Readings webcast. Joining me today, as always, is David Burrows, our Chief Investment Strategist and President at Barometer. On today's webcast, we will provide you with a brief macro overview. And of course, at the tail end of our conversation, we would be pleased to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca or hit us up on the chat or the Q&A via Zoom. And with that, on this third day of January 2023, I turn the conversation over to the one and only David Burrows. Happy New Year, David. Good afternoon.
Happy New Year to you, Pam, and Happy New Year to everybody who's joining us today.
Thanks so much.
Not so unhappy to see 2022 go. Happy to see 2023, and here we are. We got a whole new ballgame. Of course, at the beginning of the year, everybody wants to know what's going to work in the upcoming year, and that's the $64,000 question. We come out of last year with some really tough parts of the market, a lot of tax loss selling at the end of the year. And here we are in the beginning of a new year. That brings on people who held off selling certain securities or sectors because they didn't want to trigger tax. And you may see some of that. So lots of cross currents. But in general, my experience has been that the way the year finishes is generally the way the year starts. Just because we go through a calendar year end doesn't mean that the world changes. But we always have to watch because a lot of information comes out in the first few days of the year. What I want to do today is start just from the very high level. There was a lot of regime change over the last 16 months. Lots of things to consider. And it's really important that we keep looking forwards, not backwards, because some of the things that maybe have worked over the years may not be working so well going forward. And so we want to make sure that our portfolios are aligned with what's actually happening in the world. Our baseline view is that we have a basic set of responsibilities. As active managers, we don't have to be everywhere. We need to target. And so our job is to use the tools that we have and the process that we have to try to identify key market leadership themes. That's across different asset classes, that's across different geographic regions, it's across different sectors or themes or styles. Different things work well at different times. So we don't need to own everything. We aim to own productive assets in things that people care about now. We always have to watch for change. And so, of course, this is an important time of year to see if there are any structural shifts that take place. And in the absence of leadership, have a willingness to be on the sidelines. You know, we really aren't paid to be invested. We're paid to make money. And so the job is to own things that you think ultimately have the fundamental support for higher values and buyers in the market who care. So really what we're doing is taking a really tactical approach. So just from a high level, we have a view from an asset class perspective that we continue to be in a structural bull market. That started in 2013 for equities. That went a long period of time where the S&P and the Dow really went nowhere. But there's a period, you know, much like the 80s and 90s, as far as market behavior goes, it may not be the same sectors that lead along the way, and that we tend to get sort of 3 steps forward and 1 step back. And this 1 step back, you know, can certainly be painful, but it's not like what we see in a structural bear market like 2008-9, 2001 through 2003, 1973-74. You know, these types of bear markets that really are life-changing. We don't think that we're in that camp today. We've used this chart now for the last couple of years just to highlight the fact that, you know, when you're in a structural bull market in stocks, and this is the S&P, it tends to be lower bound by the 200-week moving average. As long as we remain sort of above those levels, you can continue to make a case for the fact that we're in a structural bull market. Structural bear markets tend to break those 200-week moving averages. This is the period between 2000 and 2003, and the period of 2008 through 2009. Those are very different looking periods than what we're in today. And it's important, if we are in a structural bull market, you know, to not to get too bearish, because what comes after these kind of bear market corrections, can be very, very substantial. So at this point, that's where we believe we are. And from a fixed income perspective, we think we saw generational low in interest rates in 2020, much like we did in the late 1940s. And when you wind up in rising rates, what works tends to be very, very different than what works during falling rates. We've got 40 years, all of us, of investing history through falling interest rates that taught us what works in falling rates. And to assume that those things are what's going to work going forward in a world of rising rates is not very realistic. What worked in the 1950s and 60s was really quite different than what's worked over the last few years. So we saw the 10-year yield bottom out at about 0.33 of 1% in 2020. They got as high as just about 4% in 2022. We're sitting at 3.78 here today, very close to the highs. We broke all the long-term moving averages and the trend going all the way back to 1981. We may pause here. We may correct a little, but the bottom line is we've seen a regime change, and it was a very, very tough year for the bond market last year. When you consider that bond investors in general are risk averse, this is a very tough year, worst year going back to 1786. And if we were to look across all different types of fixed income securities, there is a lot of red on the screen. And by no means can we consider this to be resolved, because when structural change takes place, it can last for a long time. When rates turned in 1951, they worked their way higher for the next 30 years in fits and starts. So this is very significant. We have to recognize that that's a major change. And again, what works in rising rates is very different than what works in falling rates. This is the yield on a 30-year US government treasury bond, coming from a yield of 0.6% to a high of 4.4, did pull back to the 150-day moving average. That was about a 23% retracement, down to 3.54%, sitting at 3.86% today. If we look all the way across the curve, this chart courtesy of my friend Charlie Bolillo, where we were a year ago versus where we are now, there's some very significant shifts in rates. That's a really significant macro shift, and of course it happened around the world. If we take what happened in the S&P last year and the 10-year treasury and build a 60-40 portfolio, no wonder people didn't like 2022. 60-40 portfolio down 17.5%. If you go back over time, you have to go back a long way to have a similar kind of result. The only one I can point to is 1931, where that combined portfolio would have been down 27.3%. So these are very unusual years, and we have to take them for what they are. But what's most important is to look forward as to where we may be going. Some important shifts in other asset classes, a big shift taking place in commodities, where we saw the bottom of a generational bear market starting in 2008, finishing in 2020. This is commodities relative to S&P 500. They turned higher and continue to look attractive. This is the long-term downtrend in the DBC, which is a weighted ETF of various commodities, fell in price from 2008 through 2020, certainly broke out and reversed it. We've consolidated since April of this past year, but this is one of the really the only asset class that was positive last year. Broad-based commodity ETF versus the S&P 500. Underperformance from 2008 through 2022, broke out above that range. And this is something that we have to consider as being a beginning, not an end. So it may be that while this had a positive return in 2022 in a very tough capital markets environment, likely we are just consolidating those initial gains, and there are likely more to come across a broad spectrum of commodities. When we look at the long-term gold chart, gold put in a high in 2011, had a long trough that went through until 2021. We consolidated over 7 months in 2022 and broke that 3 months ago. So this is November, December, starting in January up today. Interesting that gold and silver were up today against a strong US dollar. That is not a relationship that tends to be the case. It shows just how strong gold is. If we were to look at gold in euros or gold in yen or gold in pound sterling, looks even better. Gold versus the QQQ. So this is the NASDAQ 100. Gold versus the NASDAQ 100. We know how strong the NASDAQ 100 has been over the last 10 years. And we know that gold underperformed for a significant period of time. But when it turns, it can turn for a long time, as it did in 2002 and through a very tough market for tech and frankly for equities in general from 2002 through 2011, gold outperformed. Regime change. So regime changes in fixed income, regime changes in commodities, regime changes in what's working within equities, something to be considered. And this is probably the beginning when we look at the consensus bullish percent, or the percent of investors who are bullish, only just beginning to turn positive. When we look at flows, gold ETF flows, only just beginning. Something to keep in mind. This is why we've built larger precious metals and precious metals producers holdings across the firm. We know that it tends to be that you get sustained bull markets when you've been seeing deteriorating production. The reason you get deteriorating production is because after a long bear market, companies don't invest. And then you can sustain a supply-demand ratio that can support higher prices. And this is what we've seen over recent years. Real estate, the big beneficiary of falling interest rates over 40 years, as things were revalued and cap rates on commercial buildings came down along with bond yields going the other way. Relative price performance versus stocks weak, absolute performance weak. This is a basket of the largest REITs in the US, down 30%, 29.3% at the worst point. Sorry, as of today versus the beginning of 2022. US dollar, after a long run up, we talked about over the last few webcasts, made a lower high, lower high, lower low, lower high, lower low. Certainly has reversed its uptrend and has been pulling back versus world currencies. Again, something that has important implication for commodity prices, even though commodity prices can work their way higher when the US dollar is strong. So because I say we don't have to be everywhere, 70% of return is getting to the right asset class along with a tailwind, or the ones with a tailwind, and finding the sectors that people care about. 70% of return. 30% of return would be specific to individual securities. So we have two sets of tools to try to build portfolios. One, a set of tools to try to identify the pockets of the market that are seeing net new inflows. And we define that by tracking the percent of stocks or securities within a universe that are in long-term uptrends in price. We know that when the percent of stocks performing well is expanding, that's money getting put to work. We want to focus in those areas. And that may be a limited number of universes as it was last year, or it might be more broad-based in a stronger market. The second set of tools we use to try to identify specific securities to use to exploit those themes. And where we can find securities that meet our business tests in areas of the market people care about, that's where our portfolio should live. The last piece is probably the most important piece, and that's a very disciplined selling strategy. Love it or don't love it, we use stop losses on our positions. We think it's important to make sure that little mistakes don't turn into big ones, because sooner or later, every position rolls over and needs to be sold. From a top-down perspective, we're always looking for parts of the market that are showing expanding breadth. There's no bear markets ever took place while breadth was expanding. When breadth starts to contract, generally the weakest securities that sell off first are the things closest to a perceived problem. And as the sell-off picks up steam, it'll impact more and more securities. So we track the percent of securities within groups performing well, knowing if it's expanding, it's healthy. If it's contracting, we should avoid or not put any new positions on. So here's where we sit today. Broad-based breadth models globally have been weaker over the last number of weeks. Percent of stocks in the NYSE that are in uptrends has pulled back about 14% from the high. It doesn't mean everything is selling off. In fact, we're going to talk a little bit about breadth as it relates to various parts of the market over the course of the webcast today. There are some very clear weak areas and there are some very clear strong areas. One thing that's notable is over the last 2 weeks, the percent of stocks trading above their 50-day moving average has been expanding against a difficult market. So something to keep in mind. For the S&P 500, certainly the sell-off started at the beginning of 2022. We had several waves down. And as we sit, we're sitting a few percent above the lows from October. Now, an important concept to consider. When a market goes through a correction, there's a perceived problem. And at the worst point, it will impact the broadest number of securities. We know when the S&P made a low in June, 12% of stocks remained in uptrends. In other words, we're so strong that despite the heavy sell-off, weren't moving lower. When the market made its low in October and retested the June lows, only 10% of stocks remained in uptrends. I'm going to call that so far the internal low in the bear market. Now we know over the last few weeks, stocks came under pressure again, a very difficult December. But I want to just highlight the fact that as of today, 42% of companies in the S&P 500 are in uptrends, as defined by a point and figure price chart. That's up from 10% in October. Now, last week, there was a lot of discussion about the fact that the NASDAQ Composite Index went back and made a new low, a new closing low. This is the low in October. This is the low in June. 18% of stocks in uptrends in June, 20% when it made the low in October, 30% this past week. The market is a sorting element. Not everything is in difficulty at the same time. When a market is going through an attempt at making a bottom, it's important to see that the market starts to sort the good from the bad. So while I am not a fan of the NASDAQ currently, it is interesting that the percent of stocks in uptrends has been expanding on each low. That speaks to the fact that the largest of tech stocks has been the biggest problem. We know that of the 10 largest market cap companies in the US, 5 of them are in the NASDAQ: Apple, Microsoft, Alphabet, Amazon, and NVIDIA. All of them had particularly difficult years and very difficult Decembers. That's had a big impact on NASDAQ. It doesn't mean it's had an impact on the average stock. If we look at the equally weighted S&P 500, RSP, which is an ETF, versus the market cap weighted, you can see that since May of 2020, the average stock is outperforming the largest companies. And this is important because for a healthy market, we want to see broad-based strength. Now, I don't think we can say we have broad-based strength, but we have broader-based strength than we've had in a while. When we look at the Dow versus the QQQ, the Dow outperformed the QQQ from 2000 through 2004, and then the NASDAQ took off again. NASDAQ outperformed the Dow until 2022, where, again, regime change. Dow Industrials now outperforming the NASDAQ, and enough that we've reversed this trend. Now, I can't tell you how long that will continue, but it tends to be when that happens, it happens for a period of years, not weeks and not months. So I know that the CNBC loves to talk about Google and Apple and Netflix and Amazon and Tesla and when they will do well again. I would encourage you not to be too focused on that. There are other opportunities in other parts of the market. There's the TSX S&P 60. Again, looking at it through the same lens, this is relative strength versus the S&P has been rising for the last year. 24% of stocks in uptrends at the June low, 24% of stocks in uptrends in October, 40% of companies in uptrends today. These are really important things. We are retesting these original lows and fewer stocks are selling off. In 2008-9, the worst point for breadth was in October of 2008. Market rallied from October to December and then sold off into March and made a much lower low in March of 2009. But the percent of stocks in uptrends in 2009 March was significantly higher than where they were in October. The market had started to sort, and when breadth turned higher again, that was it. That was the end of the bear market. Now, we haven't seen breadth turn higher again yet, but we do know certain parts of the market are performing better today than they were in October, and these are the areas we want to focus in because that's what led after the low in 2009 or after the low in March of 2003 in the tech wreck. Now, very clearly, we're in a situation where we're going through a Fed tightening cycle. And through the course of this year, we've had lots of concerns. Recently, we saw inflation peak in the near term, and the Fed signaled that they would slow their rate of hikes. The expectation as we look forward, and its consensus, is that the economy will slow, inflation will continue to fall. At some point, the Fed will pause. There might be a potential recession, and there's lots of beliefs on that. Ultimately, that causes the Fed to cut rates and an economic recovery begins. This is an economic cycle. Remember that the market cycle does not line up with the economic cycle. The market is a discounting mechanism, and it is looking at how the economic cycle may impact certain securities. We've seen CPI roll over. And in fact, if you take the last 6 months and average it out, inflation's at 2.4%. Things are changing. When we look at the Conference Board US leading indicators, they certainly have been pulling back, but the comparisons to 2008 or 1973-74 are tough to make. Certainly, earnings per share estimates have been coming down since March of 22, and the market's been discounting these. One of the major concerns is that the market is yet to discount falling earnings. I beg to differ. We know that historically, when earnings are down 10% or more, often the decline is already discounted into the shares, and that the market winds up in the year when you get the decline in earnings. So something to keep in mind, don't get caught in consensus. Let's talk about leadership. What's changed, what hasn't? Well, we've talked now for a year about the fact that industrials have been leading the market. One of the reasons likely is the fact that there is a effort to de-link from dependence on the Chinese economy. It's likely that we're going to see a resurgence in manufacturing in the US. There is a building of infrastructure in the US, and industrials as a rule have been outperforming since beginning of 2020. When this is relative strength versus the S&P 500, a rising line means it's been outperforming. In June, when the market made its low, 14% of companies in uptrends, 18% of companies in uptrend in October. Today, 37% of companies in the industrial space in uptrends as defined by a point and figure chart. The market is sorting. Aerospace is the strongest part of that. We saw 16% of stocks in uptrends in June, 18% at the October low, 44% of companies today made a new relative strength high today versus the market. No change here. This continues to be leadership. So industrials really are not signaling a hard landing. Let's look at materials. Relative strength continues to rise. Breadth continues to improve. When we look at some of the groups within materials, the miners, for instance, breadth 12% in June, 18% in October, 32% today. Market is sorting. If we look at the long-term picture of the XME, it continues to build a base where we can move higher after coming out of the bear market that it was in from 2014 through 2021. Tech B is a great example of a broad-based, diversified materials companies trading better than 93% of companies in the S&P 500 over the last 12 months. Financials. This is a really important group. Now, remember that financials are made up, yes, of the banks. They're also made up of insurance companies. They're made up of asset managers, and Berkshire Hathaway is, of course, one of the biggest companies in the group. The XLF is the broad-based measure for financials. 30% of companies in uptrends at the June low, more, 36% at the October low, 50% of companies in the XLF today are in uptrends. Things are improving, trading above all long-term moving averages. Now, there is a case to be made in the S&P and in certain groups that we're seeing a reverse head and shoulders pattern. What does that mean? It means the market's making an attempt at making a bottom. And you can see that the right shoulder in the XLF is significantly higher than the left shoulder, meaning it's holding up much better than other parts of the market in this recent pullback in December, and that 50% of stocks are in uptrends. This is a more bullish signal. Now, this is a group that's been important through the course of the year. When we look at the XLE from the beginning of last year, up 51.6% over 262 trading days. The XLE is trading above all the long-term moving averages. Yes. It has been leadership through the course of the year. Yes. But a couple of things to keep in mind. First of all, we have seen a double top. That's something that we are somewhat concerned about. The second thing is that relative strength made its earliest high in the middle of November, and on this recent rally attempt made a lower relative strength high, and today had a particularly weak day. Now, as most know, we took our energy weight down fairly considerably from the fall. It's an important group and one that is likely can do well over a longer period of time, but we want to keep the here and now in mind. What I would say is that we have to be a little bit careful for the first few days of the year with energy because it was such a strong group. Anybody who thought about reducing positions may have held off to get through year end for tax purposes. And here we are now at the beginning of the year, we are likely to see some shuffling in portfolios. So this remains to be seen, but it's something that we're keeping an eye on for sure. The XLE versus the SPY, or energy versus the S&P 500. Did make a regime change in 2022. It's maintaining this uptrend versus the S&P. So we continue to have a bias to be positive, but we are conscious of the fact that it has been a very strong performing group over the last year. Here's another regime change. Gold producers, the GDX ETF versus energy. Again, once we see outperformance, it tends to last. This is through the teens in 2014 through 20. This is 2021 and 22, where energy was outperforming gold producers, and gold producers recently have reversed versus energy producers. This would be one of the reasons why we've been increasing our gold weights and looking at reducing some of our energy weight. So one end of our spectrum has been offense. These are groups of companies in economically sensitive areas of the market: financials, industrials, materials, and energy. At the other end of the spectrum, all year long, we've had significant weights in the more defensive sectors, those that are higher dividend paying. This is the XLV, which is a broad-based healthcare ETF, rising relative strength all through the year. Since the beginning of January 2022, down 3.6% versus the end of the S&P down 18.7. And we can see again, breadth expanding on each market low, 10% in June, 16% of stocks in uptrends in October, 26% of companies in uptrends today. This is led, of course, by the largest of large caps, Eli Lilly and Merck, both significant holdings at the firm. And United Healthcare also has been a big contributor over the course of the year. So beyond healthcare and the defensives, we have still a sizable weight in consumer staples, even though they did pull back over the last few days, down 3.7% since the beginning of the year 2022, rising relative strength and improving breadth. George Weston's been one of our biggest weights, trading better than 89% of all the companies in the S&P 500 over the last 12 months. So that's a mouthful. let's talk about the stuff that hasn't been working and what's changing and what isn't. Technology is the big elephant in the room. You can see that the IGM is made up substantially of the largest of large cap technology companies: Microsoft, Apple, Amazon, Alphabet, Meta, NVIDIA. This makes up, I think, just about 40% of this ETF. Falling relative strength all year long to today, down 36.7% since the beginning of last year. These are great companies. They are world-beating companies. It doesn't make them the right stock to own in this environment. When you have higher multiple companies and interest rates rise, it's problematic. Now, the problem is these are companies that are very, very broadly owned. And in fact, many people were accumulating through the course of the prices falling over the last year. This is something we want to be careful of. When tech rolled over in 2000 and traded down through 2001 and 2002 and into 2003, tech underperformed for a long period of time. When you get a regime change, it doesn't tend to be for weeks or a few months. Let's look at the tech sector on a relative basis versus the S&P 500. This is a very toppy looking pattern, which means that relative strength waned over a period of 2 years and likely has shifted for a longer period of time than that. Now, a very tough year for some of the biggest companies in the market. And not all of them are profitable ones. The unprofitable tech producers had an even worse year, down 81% from the high in February of 2021. An area to continue to avoid. Relative strength in communications continues to be weak, trying to find some kind of bottom here, but really not convincing, trading below all the moving averages. And when we look back at that Dow versus QQQ, just a reminder, this is something that is probably the beginning, not the end. Last couple of groups that continue to be difficult. Consumer discretionary, continues to be challenged. There are some consumer discretionary companies doing well. Bread actually has done a little better in this low than they did in the previous lows in October and June. But again, this sector is dominated by some very large players like Amazon and Tesla, which are having a big, significant outsized impact. So just a few more observations. ETFs of 6,000 that made relative strength new highs versus the S&P 500 today. There's a common theme. Value continues to lead. Aerospace continues to lead. But a new theme, Europe is starting to outperform. Something to keep an eye. We've added some European exposure in our macro portfolio. Dividends continue to outperform, making new relative strength highs over the last week versus the market. And when we break out the year, we can see just how disparate the returns were. Energy was up 58.9%. The non-cyclicals or defensives, things like healthcare, staples, and utilities, down 8%. Industrials and materials, just as defensive as the defensive stocks. And financials down 12%. Consumer discretionary, internet and retail, and tech both down well over 30%. So let's put this all together. When we look at all of the different sectors from an equity perspective we can focus in, the further up this curve we go, the higher the percentage of stocks in uptrends. So if we're headed for a hard landing, why is it that steel has the highest percent of companies in uptrends? Followed by banks, oil service, savings and loans, that's real estate, regional banks, insurance, aerospace, and builders. These are all economically sensitive groups. The groups in capital letters are the ones with expanding breadth: oil service, precious metals, and drugs on the defensive side. Odd if we think we're going to hit a hard landing. Value versus growth clearly has made a shift. That's a regime change and showing new strength again today. When we break out the different groups, core equities in the US, large cap down 19.4% for the year, growth down almost 30%. If we look at value, down 9%, mid-cap value down 13, small cap value down 16. So value looks like it is the camp that continues to lead. Now, I put this all up because we know we're living in a world where flows have gone towards passive investing, buying broad universes of stocks, the NYSE or the S&P 500 or the NASDAQ 100. Just keep in mind, if you're being a passive investor, you're lugging those large cap growth stocks that are holding things back. We had the largest outflows going all the way back to 2000, going back to over the last few years from active management. This is probably one of the greatest opportunities to be an active manager. So where are we sitting? Industrials continue to be our largest weight, up from the beginning of December at 14%, now 16.5%. That's a double weight of the S&P 500. We do hold some money in short-term bonds. This is basically cash to be deployed. It also represents the bond positions in our balanced portfolio. A balanced portfolio last year in the US was down 18%. I'm proud to say that Jim Skatakis in our balanced portfolio was down 7% over the course of the year, despite the fact having both bond and equities. Financials at 12%, a little overweight the index. Materials 3 times the return, the weight of the index, and up from the beginning of December. Energy sitting at 9%, double weight the index. Healthcare at 8%. And we go to the other end of the spectrum, real estate, utilities, technology, consumer discretionary, and communication services, all very small weights. So the portfolios really look very unlike what we're seeing in the rest of the market. Last few things. Europe starting to look a lot more interesting. Breadth substantially improving in this most recent test. December was a very tough month for markets, not much pullback in European markets, and we're starting to see some strength in the euro. I want everybody to keep this in mind. It's been a horrible 12 months. It's been about as bad as it gets. But keep in mind, when you have very difficult 9 and 12-month periods, 1 year out, 3 years out, 5 years out, and 10 years out tends to be much better. Our job is to own the things the market shows us strength. The sectors we're focusing in are showing expanding breadth against a very difficult market. By using breadth as a tool, it keeps us away from the groups that continue to deteriorate. We do think we continue to be in a structural bull market in equities, but we think there are great opportunities in commodities. We think that there are very few opportunities in fixed income other than very short-term bonds to use as an alternative to cash. What does the market think? Well, volatility readings actually are quite muted. Not what you would expect if you thought we were headed for another big down leg in the market. And credit spreads, or the excess return bond investors demand to take corporate risk versus buying a sovereign bond, have been falling for the last several weeks. This is not the picture of a market that's looking at a near-term disaster. Now, all of these things can change. And we're going to run our models daily to see what's changing for the better and what's changing for the worse. And I'll sit in front of you every week and give you the information and what we're doing about it in portfolios. We try to be transparent. If things get tougher, we've shown a history in the past of getting defensive if things get difficult. So I know there's a lot of bearish consensus, and it may well be that the economy gets tougher. And if markets start to reflect that, we're going to change our portfolios. Well, all we can do is put one foot in front of the other. And in a bear market, the most important job is to be a good seller. Stop losses come in handy. But in a bull market, and there are bull markets going on right now, the hardest thing to do is to stay with your winning positions. So with that, Pamela, if you have any questions, certainly be happy to answer them.
Hi, Dave. Of course, we have a roster of questions here. The first, starting with nat gas. Dave, North America has had terrible winter weather, as you know. Why is the price of nat gas falling? And are you bullish on nat gas going forward?
Yeah, we really aren't doing anything on nat gas right now. The trend is broken. It is a very difficult year for weather so far. And I think a lot of it has to do with the fact that there is gas that was meant to be sent out as LNG through Freeport's terminal, which has been shut down. That's having an impact as well. You are seeing some increased oil production, which is generating some additional natural gas production. So we're more focused on the oil side. You know, the best performing companies in the XLE are companies like Chevron and Exxon, a lot of the integrateds. And that's where we have a lot of focus also. So I would wait to see a shift in that gas markets before putting new money to work in those areas. And sadly, you know, weather does have an impact.
Thanks so much, Dave. Harry wants to know what percentage of the portfolio is made up of gold and silver stocks?
Well, look, you know, I'm always careful to say we're not gold bugs. But depending on the portfolio, there are very different amounts. I think that in our equity portfolio, it's about 11%, which is substantial. In our macro portfolio, it's over 20%. And that would be a combination of actual precious metals themselves, silver and gold, both performing really, really well. And then producers, mid cap and larger cap. The largest of large cap stocks are underperforming because they have falling production. But there's likely to be M&A in the space. And we also like the drillers like Major Drilling that are seeing their order books fill up with new opportunities.
Dave, thoughts on the QQQ? Would you short it here?
Look, you know, I am short in the global macro portfolio. Here we are on the first day of the year. I think a lot of people hoped that they might see the end of tax loss selling and some bid come into the market. NASDAQ wound up down about 75 basis points or 0.75 of 1% today. Tesla had a particularly difficult day, missing their delivery numbers. Look, when something is trading below all of the moving averages, and when the most prominent companies within that universe are performing poorly, you don't need to try and pick a bottom. Think about all of the people who are underwater tech over the last year. And so many of those people just want their money back, just waiting for their opportunity to get back to break even and be a seller. You don't want to buy the weakest relative strength parts of the market. You want to buy the ones that are showing resilience against a tough market. And it's just very hard to see. Now, there are some, you know, special situations in tech that look interesting, and we have for a couple of very small positions. I think 3 to 4% of the total portfolio. I just don't think. I think that we have seen a really important regime change, and I think that the NASDAQ could underperform, you know, for a long time, and it could certainly have a bounce at any time. But I would not be, you know, making significant allocations there.
Final question from Sanjay. He wishes you a happy new year, Dave. And he is curious to know if you have any insights on XAR ETF.
XAR. Well, that would be that's the another aerospace ETF, I believe, like PPA and ITA. Let me just take a quick look. Yeah, so I like it. You know, it's corrected a little off the May highs, trading above all the moving averages. A lot of strong holdings in the ETF itself. I'd be very comfortable buying it here.
That's great.
This war is not going away anytime soon, and the longer it goes on, the more resources get used, and you'll have to see, replacement. If you look at the big holdings in the XAR, Northrop Grumman, Huntington Ingalls, Axon, this is more of an equally weighted ETF. We own the ITA because it's more heavily weighted in Northrop, Lockheed Martin, and General Dynamics, the biggest, and they've done a little bit better.
Dave, that concludes the questions we've received this afternoon. So I will leave you as always with the final word, and thank you so much for another great webcast.
Look, we're really conscious of the challenges that there are in capital markets right now. But I'm also really what's the word I'm looking for?
Confident?
Very conscious of the fact that positioning is really light. People have had, depending on which areas of the market they were in, anywhere from 20 months to 12 months to reposition and become less invested. The fact that some of the most economically sensitive sectors are performing the best tells me that maybe the consensus bearishness is overly bearish. Now, we talked in previous webcasts about the fact that every time the Fed went through a tightening cycle since 1981, they created a mistake or a problem. And that's because they were raising rates against the grain. Now, I don't know if this is going to be the case, but in the 50s and 60s, when they raised rates, you slowed the economy, inflation came back into check, and the market continued on higher. I think that it's possible that that's what's going to happen. But we just got to keep watching the breadth readings. If they start to really weaken again, we'll take more defensive action. But I am optimistic about the fact that breadth readings today are so much better than what they were in October, despite the fact that the heavyweights in the NASDAQ continue to weigh on the index. It means that there are opportunities out there that are developing, and we want to try and take advantage of them in 2023. And these shifts, these regime changes, Dow versus NASDAQ, commodities versus the S&P, the regime change in fixed income, these are important regime changes, and they likely will pay dividends for those that heed them for a long time. Thanks very much, Pam, for being on today, and thanks everyone for joining us. We'll be on again next Tuesday, and if you got questions, please forward them to us. We're happy to answer them and address them. Everybody have a great week.